Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Last week we looked at the 3-month change coming out of Fed Philadelphia of all of the states across the nation. What did we say in terms of GDP overall? Well, the GDP number coming out at 0.4%, less than the original release. Once again, that low level of economic activity in here. And we talked about the 6-month leading index coming out. Well, we got it here for January's 6-month leading index, and we can look across the country. States like Texas turning from the darker green, which is 1.5 to 4.5% growth, now dialed back to 0 to 1.5% growth. We look at states like Illinois showing negative growth in here of 0 to negative 1.5%. Overall, looking at the country, that it would suggest once again that low to moderate level of growth looking forward over the next 6 months. And we got ISM manufacturing in here today. And with that is that they were expecting a reading of around 54%, which was what it was last month, and it came out at right around 51%. Once again, 50% being the level that would be the difference between contraction versus increasing growth in manufacturing. And I think that these are the kind of numbers we're going to continue to see. Of course, this week looking at unemployment being very important in here, but all of this still adds up when we look at that leading index over the next 6 months of being in that low to moderate growth. Once again, keeping the Fed in check, keeping the Fed continuing to buy securities in both treasuries and mortgage backs. So when we think about, well, what should we do in here? One of the things that I would definitely consider, and we've talked about this before, are the BQ tax-exempt securities. And we can look at a strategy, for instance, of thinking about the Fed, how long they're going to keep rates low, looking at mixtures in here. So what we're going to do is to look at a mixture of investments in 2017, 2018, 2019, 2020, and 21. We're going to look at yields in here of about a 1.06, 1.31, 1.57, 1.76, and 1.95. So if we think about 3 years out, is that that's going to mean that this part is going to be shortening itself down the curve, and we could look at an average taxable equivalent yield of about 2.16% with cash flows coming due each year. And I think that this is the type of strategy the community banks should be looking at. Certainly you could buy even shorter in that 2016 bucket, but overall I think that this is the type of strategy that gives you a decent amount of yield as well as planned roll-off as we move along during these next couple of years. That most likely will be a low interest rate period of time. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.